Hey everyone, Phil Hodgen here, and welcome to the Hodgen PC International Tax Lunch. We do this every Monday, not Monday, every month on the second Friday of the month at noon Pacific time. That's now. You can listen in online just like you're doing right now through CalCPA, or you can watch the show later on YouTube when we post it there. This month's topic is a choice of entity for foreign businesses. And for those of you who do international stuff, and I suspect that's all of you because that's why you're on the call, this is the equivalent of a domestic taxpayer coming in and saying, I want to start a business. Should I do it with an LLC or a corporation or an S Corp or blah, blah, blah. Except there are multiple variables here that are not present in the purely domestic context. So anyway, so that's our topic today. And the speaker is moi, Phil Hodgen. And first of all, I'd like to thank CalCPA for streaming this and Robert in Boulder for doing all the back-end tech work, as usual. So let's launch onto this, and I'm going to focus on three of the common structures which involve foreign corporations. So you can sort of compare and contrast and see what horror shows exist. Table of contents for your later happiness. And let's get started. So here again is the problem. You've got the puzzled American entrepreneur living abroad. And for the whole topic, let's just assume we've got a US citizen living somewhere in a country that has tax rules roughly equivalent to the United States. So anywhere in Europe, Canada, Australia, New Zealand, places like that. We're not looking at zero tax locations. We're looking at places that have actual corporate and individual tax rates. And when we're looking at the choice of entity, there are two things we're going to look at, one of which is cash, obviously, duh. So revenue comes into this red box foreign business entity to be determined from the customers and bleeds off to foreign taxes, and it bleeds off to vendors and whatnot. And whatever is left afterward is going to come out to our American entrepreneur abroad, either as a salary or as a dividend. Those are the two ways you're going to get cash. Yeah, you can play games with the loans, but sooner or later, these are the two things that are going to happen to the cash. And I'm going to look at these whole question as if we're going to follow a dollar in real time from revenue in from the customer to the pocket of the American entrepreneur abroad. And we're going to flow it all through in the current year on the theory that you're only free of the US government and the tax authorities generally when you've got a dollar in your pocket. And any of you who remember what happened with our friend Section 965 knows how fast the tax authorities can turn on you, and you do not want to rely on tax laws for your long-term business planning. So short answer is get the money out of the business and into your pocket and be a free human being. So if we look at cash that way, we're going to flow it all the way through to the pocket of the owner so the owner can walk outside and go buy a beer. These are the three US tax problems we have to solve when we're looking at what's the choice of entity. First one is profit. So one of the happy features of the US tax code is that they have subchapter C, which says a corporation is an independent taxpayer from the shareholders. And then there's subpart F, which says, just kidding, the subchapter C rules don't apply when you have a foreign corporation. And we have two flow-through rules, Section 951A, which is the subpart F income, and we have Section 951 Cap A, which is our new friend from the Tax Cuts and Jobs Act, which basically sucks out whatever isn't subpart A, and generically I'm just going to refer to it as operating profit, and makes it immediately taxable to the shareholder. So profit is a problem. The next thing is cash distributions. And you know that cash distributions from a corporation are traditionally dividends, and dividends are income until proven otherwise. So we've got to worry about that. And the final thing is foreign tax paid. All else equal, we'd like to have our American entrepreneur abroad be able to take a foreign tax credit so that a particular item of income isn't double taxed, one in the foreign country and then again in the United States. So here's a little picture with 11 ideas that I can think about, and there are probably more if I sat down and thought about some more. I'm not saying these are good ideas. There may be some dumb ideas. There may be some impossible ideas. But here are some ideas. The important thing for you to look at is they fall into 4 general quadrants. There's the pass-through kind of structures. There's C corporation that are domestics, those kind of structures. So you have a Delaware corporation doing business abroad for reasons unknown to us. You have foreign C corporations, which is where we're going to play today. And we have parent subsidiary structures. So I'm going to pick 8, 10, and 11. So a generic controlled foreign corporation directly held by an American entrepreneur abroad. Number 10, which is the same thing, but with a Section 962 election, which is a transformer mechanism, not unlike making a subchapter S election for a domestic corporation. And finally, we're going to use El Clasico that Congress seems to love, the parent subsidiary structure. And I've got to say that the parent subsidiary structure is probably not viable for many, if not all, well, not many. There will be some people that can use it, but for many people abroad, adding a U.S. domestic holding company above a foreign operating company is just going to cause brain damage in that foreign country, and it's not feasible. But I'm going to show you anyway, just so you can see how the numbers crank out, and it may or may not be a useful idea for your client. So here are the 3 choices we're going to look at today. Let's look first at the generic foreign corporation, this El Clasico. And this one truly, I mean, on the waterfront, Marlon Brando, I could have been a contender instead of a bum, which is what I am. And this one is really a bum now, ever since the Tax Cuts and Jobs Act. You're going to see this at the end of the little section here where I do let's roll up and count all the taxes and see what the effective tax rate is, and it's horrific. A little bit of overview. This is the technical nerd part. So operating profit. Remember I talked about how operating profit is included in the shareholder's gross income, even though this is an override of the subchapter 3 concept that a corporation is a separate taxable entity from the shareholder. No more. It's a straight flow through of the operating profit. And I'll show you how it calculates in a few slides from now. The next bullet point down is, we'll talk later about this special Section 250 deduction, which reduces the inclusion of gross income from Section 951 Cap A by 50%. And forgive me for the potty words I'm about to use, but the Tax Cuts and Jobs Act presented Americans abroad with a shit sandwich. And the shit sandwich is that Section 951 Cap A flows through operating profit in real time to the individual tax return of the American entrepreneur. And the bread around it, number 1, was, hey, look, we gave you 50% off with Section 250. Yay. You know what happened to the meals and entertainment deduction. You know what happened to itemized deductions. You know what happens to other deductions inevitably over time. This will go away. And in fact, it's hardwired into Section 250 that it drops from 50% to 37.5% in a while. So don't expect it to stay long, because Subpart F income is taxed at 100%. So sooner or later, we're going to lose this thing. Anyway, I'm not bitter. Dividends. Dividends are not included in gross income. Yay. And this has been true since 1962, and it remains unchanged. And the foreign tax credit, this in El Clasico structure here, the individual shareholder does not get to take a foreign tax credit for the corporate income tax paid by the controlled foreign corporation. So, because we're all tax nerds here, let's do some math. Here's my assumptions, just a high level. We'll add a few other assumptions in as we go along. But for all the models that we're going to compare and contrast, this is what it is. I'm just assuming that the foreign corporation has $600,000 of gross revenue from customer sales, pays $100,000 of salary to the shareholder who's living in the foreign country. You can see that Foreign corporate income tax rate, I've assumed is 30%, and I've assumed a 40% individual tax rate in the foreign country. And we're also going to assume that whatever is left cash in the kitty at the corporation is going to be paid out at year end as a dividend to the shareholder. So quick math, here's what the corporate income tax is. 600,000 gross minus 100,000 of expenses, 500,000 taxable income times 30% tax rate equals $150,000 of corporate income tax paid offshore. Bing, easy. By the way, all of these things, you've got an Excel spreadsheet along with the slides, and it has all my in-depth hyper-nerd calculations for all of these models. So take it, play with the model. Please do not judge me on my Excel skills or lack thereof. And if you debug it and you find something that I did dreadfully wrong, please tell me. Anyway, back to the dividends. Dividends are easy. We got 600,000 of cash in from customers, spent out 250,000, 100,000 to salaries, and 150,000 for cash. That leaves to tax. That leaves 350 left over. We pay out the entire 350,000 as a dividend to the shareholder. So now we know what the shareholder is going to get: 100,000 of salary, 350 of dividend. Let's look at what the shareholder's foreign personal income tax looks like. There's your salary, 40% tax on it is 40 grand. There's your dividend, 350,000. There's your 40% tax rate, 140,000 of foreign income tax paid. Total foreign personal income tax paid, 180,000. Now let's get to the horror show. This is our friend Section 951 Cap A. I am not going to use the acronym for this because, frankly, I think the US government is trying to use brainwashing techniques on us by every time we say the acronym, say, I have that word, I am that word, and implicit in that is not a good message to your subconscious. So stop using the acronym. If you take nothing else from this international tax launch, stop using the acronym. So we have $600,000 of gross revenue. Okay, that's going to be included. And then we subtract a bunch of stuff to figure out what the gross inclusion is. And if you want to find out where this is, go look at Form 5471, and it's on Schedule I-1. So that's where you're going to find all this stuff. So first of all, you start with the gross, and then you subtract a bunch of stuff that's frankly taxed other ways, or there's some sort of implicit benefit that's already hardwired into the code. And whatever the residual is the operating income, which is taxed under Section 951 Cap A. So you subtract those statutory items, and that's line 2 of Schedule I-1. And then you subtract allocable expenses that apply to this residual income that we're working with. And since by assumption we only have this operating income, all of the expenses, the 100,000 salary is applied to it, and all of the taxes are deducted. And 100% of the foreign income tax paid by the corporation is allocable to this residual type of income, which is the gross income inclusion of 350,000. Now, for this easy and hyper simple model, because I didn't want to make my Excel model too complicated, I'm ignoring the standard deduction. So taxable income equals gross income. And I'm applying the highest marginal tax rate of 37% to this income, which yields an income tax liability of $129,500. So, an aside, pimping myself, July 10, I'm doing a 2-hour topic on just this thing, the Section 962 election and taxation and all of this stuff. And if you want to, just go to hodgin.com/events and you can sign up for it. In fact, when you see the effective rate, the federal income tax rate is 31% for reals, not the 37% highest marginal rate. But that's just an aside. So this is overstating the tax liability. It's just a tidge. So it's important to note what's not here. Again, we don't get the Section 250 deduction. Why? Because only domestic corporations get that deduction. Humans don't. And second, there's no foreign tax credit. Why? Because Section 901, which is the foreign tax credit rule, says a taxpayer gets a credit for taxes paid or deemed paid. Well, the human didn't pay the tax, the foreign corporation paid it, so the paid part is out the window. And Section 960, which is the deemed paid foreign tax credit rule, says that this is only allowed for corporations, not for humans, so the individual can't take the deemed paid either. Therefore, there's no offset of this $129,000 by the $150,000 of foreign tax paid on the corporate income. So we got a double tax problem. And this right here, that bullet point, that lack of a foreign tax credit is why you do not want this structure. So let's look at the dividend income. Dividend income received $350. Section 959, there should be parentheses around that, says 100% exclusion, zero income tax, but the net investment income tax rules has a different definition of what's taxable base for that tax. So you have to pay the 3.8% on the dividend for $13,300. And again, important to note what's not there. The foreign tax credit doesn't work here because you paid foreign income tax individually, but 904 is the smaller of U.S. tax or foreign tax paid, and zero is smaller than 140,000. And also the foreign tax credit doesn't apply to net investment income tax. Easy peasy for salary income under the structure, 100,000 of salary income, you're going to get the foreign tax paid credit under Section 901 because the individual actually paid the foreign tax of 40,000, and the max allowable is the U.S. tax on it. So 37 minus 37 equals zero net salary income tax. So here's the scary total: 150,000 for corporate income tax, 180,000 combined for salary and dividend for foreign personal income tax, 129,000 for Section 951 Cap A, and the net investment income tax of $13,300. Magic 78.8% effective tax rate worldwide. Ha ha. Not bad. So I think this is something that, unless you can find a magical workaround, and cliffhanger, I'm going to tell you one on the very last slide, which may work in some cases but may not in others. I think you have to do something other than have a classic U.S. human owns shares of a foreign corporation. Let's look at the Section 962, and this is what I think is the rule that, the first thing you can look at. So this is an election. So from the foreign corporation, from the foreign country point of view, the corporation looks exactly the same as before. It's just something weird happened for U.S. income tax reporting purposes. Again, not unlike making a S election for a domestic corporation, and then weird stuff happens as to the individual's net tax liability because of the corporate activities. So the difference, now we get the 50% off because Section 962 in plain language says, hey, you, the human being, pretend you're a corporation for some of these tax attributes. And so we pretend that the individual is a corporation for the Section 951 Cap A income, and therefore, because we have a pretend corporation, we get the real life Section 250 deduction. So yay. The second thing is, because the individual is a pretend corporation, the individual gets to use the corporate tax rates of 21%. And so you see that the operating income gets 50% of it is not included in income, and then whatever is left is taxed at 21%. So it's a 10.5% effective tax rate, which is pretty good. Subpart F income, on the other hand, doesn't get that 50% off thing, so the effective tax rate is still 21% on Subpart F income, which is not bad compared to 37%. So here's your little quickie comparison. What's good, what's bad? Section 962 election good, not bad. The next different thing, dividends create gross income when you have a Section 962 election. And why is that? Because the Section 962 election says explicitly that Section 959, which you remember gave you the 100% exclusion for dividends received from a foreign corporation, that's out the window explicitly in Section 962. And instead, it has this special rule where you bifurcate the dividend paid into excludable and taxable. And you can see the rule in Section 962D and the regulations under it. Little hint, if you're operating in a country that has a foreign corporate income tax and you're claiming the foreign tax credit, effectively this is useless and 100% of the dividend is going to be taxable. And the reason is because excludable dividends are based as a function of the amount of tax that you paid on the included income under Section 951 Cap A, but that's net of foreign tax credit. So you pay. Well, you'll see it in the math as we go along in the models coming up. So here's the bottom line for Section 962 elections versus not. Section 962 elections are bad for dividend income. Next, indirect foreign tax credit. Indirect foreign tax credit is allowed when you have a Section 962 election. Why is that? Because the 962 election says, pretend the human is a corporation, and the corporation gets to take a foreign tax credit. So yay, right here, the Section 962 election says that we've got some green bonus happy times here. And here's the addition of all the threes, good, bad, and the ugly. And I've got to say, and you'll see the math as it comes through, that the ability to take the indirect foreign tax credit is the critical element of making the Section 962 election, yes or no. So let's start at the top again. We're going to do some more math and we'll compare the Section 962 outcome compared to just the El Clasico, I own a foreign corporation, look at me. So we still have the same total foreign tax paid, and you just sort of take the foreign tax paid as granite in the earth. It'll never change, and you cannot manipulate it. So there it is, $150,000 to the corporate income tax and $180,000 total for the individual income tax. The shareholders' 951 Cap A income. This is where things change radically for the better. So look at how we do the math again. We start by looking at the foreign entity's gross income, $600,000 from sales, and then we subtract a bunch of stuff, which again happens on Form 5471, Schedule I-1. And you subtract other statutory categories of income, so that's Subpart F and high tax exception, and I can't even remember the others. But anyway, we have none of those in our little example here. We subtract allocable expenses, the salary. We subtract allocable taxes, the corporate income tax imposed on this foreign corporation, $150,000, and we have the gross income inclusion of $350,000. Now we get to take the Section 250 deduction. Hooray, 50% off, deal. And so taxable income is only $175,000. And then, bonus time, we get to compute the income tax liability for the individual using corporate tax concepts. So that includes 21% flat tax rate. So we have an income tax liability on the Section 951 Cap A income of only $36,750. So compare that in your brain with $129,500 and ask yourself, what would you rather have? I know what I would like. I would like this. And then let's look at the foreign tax credit. Unlike the El Clasico, direct ownership without any elections, we get to take the Section 960 tax credit. And here's how it rolls out. We start with the actual foreign tax paid, $150,000, and then there is a limitation on how much you can take as a tax credit against Section 951 Cap A income. And in our, forgive me again, shit sandwich that Congress gave us for Section 951 Cap A income, this is the other piece of bread. Instead of giving you dollar for dollar possibility of foreign tax credit, they only give you 80% of actual tax paid as your limitation. So in some cases, you're going to hit a wall and you're going to be unable to fully use all of your foreign tax paid. Sorry, too bad for you. Anyway, so now we only have 120,000 that the government pretends the foreign corporation actually paid in income tax. And now we go down to Section 904. And you remember Section 904 says that the taxpayer gets the minimum of actual foreign tax paid or the U.S. tax liability on that income item, or technically everything in the bucket on the foreign tax credit calculation paid form. And here, U.S. income tax is way lower, so the maximum allowable foreign tax credit is going to be the $36,750, which entirely offsets the income tax liability against the Section 951 Cap A income. So we've zeroed it out, and you really can't do much better than that. So we're happy, despite the 80% rule and the 20% haircut that we have to give back to the government. And so here are just the words that go with it. But the point that I want to make is there is wait, there's more. So if we're on TV and they're selling you knives, we're going to get you a little bonus thing. And that bonus thing is Section 78. And Internal Revenue Code Section 78 goes hand in hand with the foreign tax credit rules. And the idea here is that if you, the U.S. shareholder, take a foreign tax credit, the indirect foreign tax credit under Section 960, we don't want you to not only take a tax deduction, reducing your includable income by the amount of tax paid, and give you a tax credit. In other words, you don't get deduction and tax credit, you only get the tax credit. And so the little myth that they build into the code is that the foreign company is deemed to have given you a dividend equal to the actual tax that the foreign company paid. And then you, the U.S. shareholder, we pretend that you use that money to pay the foreign company's tax. And so it grosses up your income by the amount of the foreign tax paid by the foreign corporation. So here we are. We have a deemed dividend, and Section 78 says this is treated as a dividend for all purposes in Title 26. So it's a dividend, and it's included back in your income, $150,000. Section 250 allows you a 50% off deduction for this because it says so in Section 250. So the taxable income from your Internal Revenue Code Section 78 dividend is only $75,000. You apply the 21% tax rate, and you have a $15,750 tax liability because of this gross up. Fortunately, it works both ways. What is grossed up can be taken, you can take a foreign tax credit against it. And so when we roll through the math here, you're going to get a foreign tax credit equal to the tax liability that we just calculated on this Section 78 dividend. So $15,750 of tax liability minus $15,750 of foreign tax credit. Net tax liability, zero. So what do we have here? Step back a bit and compare what happened with the El Clasico structure, direct ownership of a controlled foreign corporation, where the Section 951 Cap A inclusion created $129,500 of tax cost, whereas with the Section 962 election for exactly that same structure. So everything else is unchanged for business purposes and for foreign tax purposes, but for U.S. income tax purposes, everything's changed. because now the net tax liability on the Section 951 Cap A income is a mighty zero. So that's $129,500 tax savings because you make this election. And that's the game right there, folks. Dividend income. Remember I said that Section 959 is out the window when you make the Section 952 election. So you don't get to take a Section 350,000 dividend from the controlled foreign corporation and exclude 100% of it from your gross income because of Section 959. Now Section 962 makes it taxable. But remember, I didn't make another little table, but I probably should here. Remember that the American abroad paid a metric ton of individual income tax on the dividend income received at 40%. And here, dividend received, and I'm assuming it's ordinary income, not a qualified dividend, is the $129,500. There's a typo. And so you've got one netting against the other. The maximum under Section 904 is going to be the U.S. income tax on the dividend, which at 37% is going to be less than the tax paid in the other country at 40%. So the net income tax liability on the U.S. tax return for dividend income included in income is zero. But you're still going to pay the net investment income tax of $13,300 just because that's the way Congress wrote the rules. Salary income, again, the direct foreign tax credit under Section 901 and 904 is going to say you have 37% tax on $100,000 of salary, but you have a $37,000 foreign tax credit. So net tax liability on the U.S. return is zero. And this is what you see day in and day out for an American working abroad, preparing the 1040 for that person, that routinely the net tax liability to the U.S. is zero because of the foreign tax credit. So let's look at our magic total tax paid by everyone everywhere. First, take a glance at the bottom line, 57.22%. That's rather better than 78.8%, right? Let's look at where that tax came from. Well, almost entirely it came from the foreign side of the equation, the foreign corporate income tax, $150,000, and the foreign personal income tax, which is $180,000, and then a little dribbly piece of $13,300 for the net investment income tax in the United States. So significantly better. And I would say that if you have a situation where an existing business has this situation of a direct ownership by a real human, think strongly about doing the 962 election, do the math, and I suspect the number is going to be more palatable to the owner of that business than what it is without the election. All right. Now let's get into the final equation. So remember, we have this direct ownership. Our first little example was we had just direct ownership without this 962 election. The next example was the direct ownership with the 962 election. And we saw that that reduced tax substantially from 78.8% to 57.22%. And now finally, let's look at the parent subsidiary structure. So this is the structure that I think Congress doesn't use its own brains. Congress uses brains supplied by lobbyists, and lobbyists are bought by Apple and Google. And therefore, I rather suspect that Congress thinks all multinationals are Google and Apple sized, not normal human being sized, like the little American mini multinational that we're looking at here. And I call it an American mini multinational just because you have a regular person running a regular kind of business, 100% in a foreign country. I mean, think of it this way. It could be a dry cleaner, it could be a gas station or anything like that. Yet it's a mini multinational because the owner is an American taxpayer and the American system has the worldwide system of taxation. So it's a mini multinational. Congress, to say that a little entrepreneur like that is a stepchild is overstating it, I think. But I'm not bitter. So let's look at how the numbers roll through. The domestic parent foreign corporation, we're thinking of the controlled foreign corporation as the operating entity. The domestic C corporation is a pure holdco. So you set this up in Delaware or wherever, but it's going to be inert except for receiving the Section 951 Cap A deemed income inclusion and receiving dividends from its subsidiary, and then doing whatever it wants to do with the net cash, which in our example is going to be, we're going to distribute 100% of dividend income upstream to our individual shareholder, and we're going to see what happens, because we want to get money out of the corporate structure as quickly as possible so our shareholder can go buy a beer. So the assumptions in this model are a little bit different. And I'm going to go a little bit slower than the gallop through the first ones, because those are pretty much straight flows from entity upstream to a human and then boom, done. Here we've got some crisscross stuff going on. We're going to have the US share, the individual, let's call this person the individual, is going to receive two sources of income from two different places. The operating subsidiary is going to pay the normal $100,000 salary. And now the operating subsidiary is going to pay $350,000 dividend upstream to its shareholder, which is not the human, it's the domestic holdco in Delaware, let's call it. So now the Delaware holdco has all the cash, and I'm going to show you how the $350,000 cash flows upstream from the foreign subsidiary, the operating entity, to the holdco, and then out from the Delaware holding company to the pocket of the individual shareholder, and how that all works and how it calculates out. So let's see how the numbers crunch in this kind of scenario. Now I said crisscross because it looks kind of weird. And so where things were a little bit simple, we could just follow flows of income and deemed income and attributed foreign tax paid up from the foreign subsidiary to the individual shareholder rather simply in the first two cases. When we have a parent subsidiary structure, it gets a lot more complicated. So the red stuff is foreign and the blue stuff is domestic. So look at this for just for a little bit. You see we have a bunch of crisscross interaction stuff happening, and we have money at the end going out in gray to either foreign corporate tax, foreign individual tax, domestic corporate tax, or domestic individual tax. And let me just flow you through the concepts right now of this diagram. Start with a foreign subsidiary tax return. It's going to do a bunch of stuff, and we sort of saw how it worked in the past. You know, it's going to pay a salary, it's going to pay some income tax. And then the three down arrows in red to the US parent are what passes down or up, depending on your point of view, to the shareholder. Section 960 is the indirect foreign tax credit. So this passes the tax credit functionality to the US parent corporation's tax return. The actual cash dividend gets paid to the parent corporation. And the Section 951 Cap A gross income inclusion gets passed upstream to the US parent and gets all processed through on the Form 1120 for this holdco. So that's what happens at a first glance. And now let's see what happens from these two operating entities and how it interacts with the human, which are the two boxes on the right. So the human's foreign individual income tax return is going to show two things. It's going to show a salary coming from the foreign corporation. And that salary, by the way, also flows through to the individual's Form 1040. Now, why is that? Well, it flows through to the individual's foreign individual income tax return, too many individuals there, because of residence rules. Everybody on the planet except us and Eritrea says, we tax you if you're a resident. And by assumption, this person is living in that country 365 days a year, running a dry cleaning business. And so residence-based taxation there. And the salary flows to the Form 1040, the blue box at the bottom right-hand corner, because we have citizenship-based taxation saying we don't care where you are and where you earned it. It's all taxable on your Form 1040. Right. So next we've got the U.S. parent company. What happens here? Well, it has dividend income that it wants to pay to the shareholder, the individual now, the shareholder of the parent company, and it's going to pay it. And Delaware Corporation pays dividend to U.S. citizen. Classic. That's that horizontal blue arrow to the right. Goes on Form 1040, Schedule B, like everything. Right? Nothing magical there. But also, you think about it from the perspective of the resident-based taxation for the foreign country where this person is living. Person got a dividend, $350,000. In that case, from the perspective of that foreign country, it's a foreign dividend, right? Because it came from a U.S. corporation, which is not Spain, Canada, whatever. But it's still going to be $350,000, part of the taxable income for that foreign country purpose. So that's why there are two arrows going that way. And then finally, the two up-down arrows between the two individual income tax returns for the human. This is going to be a little bit weird and more complicated, but let me explain why. So let's first look at the foreign tax credit for salary. So on the foreign income tax return, the individual is going to pay $40,000 of tax at 40% on the salary. The $100,000 of salary is also going to show up on the individual's Form 1040. And this is the classic situation of American living abroad claiming a foreign tax credit on Form 1116 for earned income. Well, let's look at the other one, the up arrow that's blue for the foreign tax credit on the dividend. What's happening here? Well, the dividend income, $350,000, is going to get taxed in the foreign country at 40%, and it's going to get taxed in the United States, this time as a qualified dividend. So it gets double taxed. Somebody's got to give a foreign tax credit. Well, who's it going to be? Well, it ain't going to be Uncle Sam, because Uncle Sam doesn't give you a foreign tax credit for foreign taxes paid on dividends from domestic corporations. Go away. But I'm going to assume that the foreign country has kind of the mirror image of our foreign tax credit rules, which say that if you paid, foreign tax in another country on this thing, we'll give you a tax credit. So that's why the foreign tax credit is passed upstream from the U.S. tax return, and it's going to be offsetting individual income tax liability on the individual's foreign income tax return. With me so far? It's kind of complicated, but this one I hope helps you understand what's happening as we go through the model. Operating income still gets handled in the same old way that we've done it before. Gets included because of Section 951 Cap A, and because the U.S. shareholder in this case, who is receiving because it's an it, not a person, which receives the gross income inclusion of Section 951 Cap A, gets to take the Section 250 deduction, which is reserved only for corporations, and hey presto, we have a domestic corporation in the form of our Delaware holding company. Dividend income. Again, general rule is dividend income is included in gross income of any U.S. taxpayer, Section 961, which is, the book of Genesis according to the Internal Revenue Code. Everything starts at Section 61. But Section 245 Cap A gives a 100% dividends received deduction for dividends received by a domestic corporation from a foreign corporation. Yay, hey presto, the net result, and this was one of the keystones, hey, look at us, look at what we gave you, that Congress keep yelling about, is we allow you to repatriate cash from your foreign subsidiaries tax-free. So that's what happens. So as the $350,000 of cash comes upstream from the foreign subsidiary to the domestic corporation, it's going to be 100% tax-free on the Form 1120 that you're preparing for the holdco. So yay for that. So what this means is that if you can find a way to zero out the tax liability on the gross income inclusion created by, let's pretend, under Section 951 Cap A, we win because the holdco is going to have a net corporate income tax liability of 0, which is fabulous. And here's the clue, Section 960. So just as it worked super well for the situation where you had the individual make the Section 962 election, the Section 960 indirect foreign tax credit works super well for the classic parent subsidiary structure. And you're going to see how, just as with the Section 962 election scenario, the indirect foreign tax credit is going to 100% offset the Section 951 Cap A gross inclusion and the tax liability on that. So net tax liability on the Section 951 Cap A inclusion after foreign tax credit is going to be 0. So we have 0 tax on dividend, 0 tax on the let's pretend gross income inclusion of Section 951 Cap A. Winner, winner, chicken dinner. Let's run through the numbers real fast. Parent corporation. So parent corporation is plugged into the foreign operating subsidiary. Here's what its Section 951 Cap A income looks like. Start with the gross, same game as usual. Subtract the statutorily defined income categories, 0 in our example. Subtract allocable deductions, 100,000 salary. Subtract allocable taxes, 150,000 of foreign corporate income tax paid. Gross income inclusion, 350,000. Less the Section 250 deduction, 175,000, yields taxable income, 175,000, tax rate, corporate tax rate, 21%, net tax liability, $36,750. Yay. Tax credit allowed, start at the top, total tax really truly paid in real life, 150,000. Section 950D limitation, 80% of actual. We start with 120,000 pretend paid. We look at those next 2 lines. We will compare the 120, I should say, against the 36,000, which is the actual U.S. tax liability paid of 36,750. Section 904 says take the lower of those 2 as the allowable foreign tax credit under Section 901. So our allowable foreign tax credit is $36,750. Not so coincidentally, the exact precise amount of tax liability that we have on the Section 951 Cap A income. Net tax liability is 0 on the Section 951 Cap A income. So there you go. Words. And segue into Section 78. So remember that we'd have to do the gross up. So here we do the gross up. Gross up the parent company's income by 150,000. This drops onto its own dedicated little line on Schedule C of Form 1120. I forget the exact line, but it's there. Less the Section 250 deduction, which also goes on Schedule C in the right-hand column. Which is going to result in taxable income, specifically just as to the Section 78 dividend of 75,000, tax rate 21%, tax liability $15,750. Foreign tax credit, magically we have the $15,750 foreign tax credit against the Section 78 dividend, which is fabulous. Again, this is because it's the lower of foreign tax available for credit versus actual U.S. tax liability paid. And obviously in this scenario, the U.S. tax liability paid is far, far less than the actual tax paid in the foreign country. So the Section 78 dividend, we have tax liability up minus foreign tax credit allowed, down, net zero. And there are the words that just describe what I just said. Dividend income, just to have it on the table to reinforce the idea of the Section 245 Cap A 100% dividend received deduction allowable for domestic corporations. We've got zero taxable dividend income, therefore, by definition, tax liability is zero on the dividend income. The individual. Here's what's happening on the individual side. And the purpose of this slide is to show you, let's see, the third line from the bottom, the one that says 83,300 in parentheses. This is showing you the effect of the foreign tax credit allowable on the foreign individual income tax return, where that foreign country, Canada, Spain, whatever, is allowing a foreign tax credit, foreign under their laws, for the US tax paid on the dividend income. So that's how it's showing that you're not going to have a double taxation on the dividend income. Otherwise, everything is exactly the same as before. The individual's foreign income tax, notable, so here are the words that go with it, is I'm making a heroic assumption about the other countries' foreign tax credit rules. And I'm doing that because I have to make a generic assumption for generic countries worldwide. But it's not going to be necessarily too far off, particularly if you have a tax treaty, which is going to allow something reasonably close to this. Whether it allows the tax credit for the net investment income tax or not, I don't know. But for heroic and simplified purposes, I'm going to say it does. But the bottom line is, at the individual level, the individual is still receiving a $350,000 dividend, this time from a domestic corporation instead of a foreign corporation. But still, we only have a single layer of tax at the individual level, at the higher of the two rates, foreign versus United States. And routinely, it's going to be the foreign country rate is going to be higher than the US rate. Salary, again, we have an American living abroad pulling a salary. This is the classic scenario where Form 1116 does its magic and allows a tax credit equal to the lesser of actual foreign tax paid versus US tax liability on the same category of income. So here we're taking the lower, which is the US tax liability, which is $37,000, and we're good. So net US income tax liability on salary income is zero. Here's just a quickie to show you what's happening on the US individual's income tax return for US tax liability that's going to show up on the Form 1040, why it's going to be $83,300. It's because the dividend from the Delaware corporation to an American citizen is going to be a qualified dividend. Therefore, it's going to be taxed at the lower rate, the long-term capital gain tax rate, 20% by assumption, plus net investment income tax. So 23.8, total tax, $83,300. And remember from a couple slides back, the foreign country is allowing an offset to this foreign tax credit in the other country. So net to the taxpayer's wallet is a tax liability of zero to the United States. So the total taxes paid everywhere by everybody. Let's look at this number. We start again. The foreign subsidiary is going to pay the $150,000 of corporate income tax because that's unchanged always. Then it's passing all the income upstream to it, and by all the income, I mean Section 951 Cap A deemed income and $350,000 of dividends actually paid in cash to its shareholder, the foreign parent corporation. And we saw that the dividend is excluded entirely from gross income of the parent corporation, so zero. And we saw that Section 951 Cap A income is completely offset by foreign tax credit, so zero income on Form 1120 for the parent corporation. We drop down to what happens at the foreign personal income tax level. Same thing as before. From the perspective of the foreign country, they have a resident, the resident paying tax on actual income received, salary and dividend at 40% tax rates, with one exception. Now, because the resident is receiving a $350,000 dividend from a US corporation, the foreign country is going to allow a foreign tax credit on their tax return for the $83,300 paid to the Internal Revenue Service. So that's going to reduce the net tax bill on the foreign individual income tax return. On the US individual income tax return, we've got the salary of $37,000 completely offset by foreign tax credit, and we've got the tax liability on the dividend, which isn't offset on the individual Form 1040, but is offset on the foreign side of the equation. And your net tax liability and all of that turns out to be $365,000 or 60.83%, so slightly worse than the Section 962 election. So let's sort of wrap it up here and talk about why and what next and all that. So here's your comparison table. What's good? And as near as I can tell, for normal kind of humans, American mini multinationals, if Google and Apple are your client, vaya con Dios. But for the rest of us who are dealing with entrepreneurs who have privately held businesses, sometimes pretty significant and sometimes not, and I've got just a very average kind of business here, it looks to me as though all else equal, I think you put your focus first on Section 962 election. And I do that because all else equal, for foreign tax or foreign business practicalities, a corporation is going to be the business entity of choice for the entrepreneur to use. Or they might have it already and you're kind of stuck with it for historical reasons. So the Section 962 election is going to be your choice. But I sort of gave you a hint about an idea that you can play with. And here it is. The basic concept is see if you can find a way to zero out the net profit in the foreign corporation. So this harkens back to loan-out corporations, which were a big deal when I started doing all this fun stuff. And I'm in LA, and so there were entertainers, and they would set up a corporation. They have 100% ownership. They are the sole shareholder, sole officer, sole director, and you pull money in from working on a movie and you pay money out, zero out the tax liability on that C corporation, zero tax, and it works out really well. And that was for a bunch of different reasons. But the same idea works here. So let's just do a thought experiment. I didn't do a math table. $600,000 gross income at the level of the corporation, minus a $600,000 salary to the shareholder. What does that do? Well, in the foreign country, you've got $600,000 of salary income times 40% is a $240,000 personal income tax liability, zero corporate tax. What does it do in the U.S.? Well, there's no Section 951 Cap A inclusion, right? Because zero net taxable income, so nothing to pass upstream to the shareholder. You don't have to fuss around with the foreign tax credit because no tax was paid in the foreign country. And then you look at the individual side, the Form 1040, and you've got $600,000 of salary taxed at 37%, and as compared to 40% in the foreign country, and you're going to get Form 1116 giving 100% offset, so zero tax liability on Form 1040. And that's an effective tax rate of 40%. So my first suggestion is make a 962 election and then play with the way you operate the corporation. There you go. Here's my last admonishment, and I just want to repeat that pay attention to real-world practicalities first, and then play with the U.S. tax implication of those real-world practicalities. I got to say that you might want to look at the disregarded entity election. That might be another interesting way to maximize the effectiveness of the whole flow-through tax structure to the U.S. individual's tax return. Here's my disclaimer, and all that kind of fun stuff. I'll leave it to you to read. And that is it. We're done with 3 seconds to spare. We'll see you August 14 for the next tax lunch. And again, July 10, there's a nerd out on section 962, 2-hour extravaganza, hodgin.com/events for more information. Bye, and I will turn it back to Robert. The end.